today's market, looking at headlines in isolation can be misleading. But when you connect the dots between capital flows, government policy, and macroeconomic trends, you start to see where the real opportunities and risks are emerging. Welcome to Smart Real Estate with LearnInvestManage.com, your source for in-depth investor-focused insights into real estate market. I'm Addy Saeed, and in this segment of Multifamily Market Intelligence, we break down the key economic policy and transaction-driven developments shaping apartment investing across Ontario and Canada. This episode is about connecting signals, because in today's market, looking at headlines in isolation can be misleading. But when you connect the dots between capital flows, government policy, and macroeconomic trends, you start to see where the real opportunities and risks are emerging. Before we begin, a quick disclaimer: this podcast is for informational and educational purposes only and should not be construed as financial, legal, and investment advice. All opinions expressed are based on current market data and are subject to change without notice. Listeners should consult their professional advisors before making any investment decisions. Over the past week, we've seen four major developments: a $91 million apartment sale in Midtown Toronto, an $8.8 billion housing infrastructure announcement, a $1.1 billion small business tax cut, and new economic data showing a widening trade deficit. Individually, each of these tell a story, but together they reveal something more important. Ontario multifamily is not in a boom and it's not in a downturn. It's in transition. Let's start with the transaction. Minto sold a 148-unit apartment building at Yonge and Eglinton for approximately $91 million. That's $613,000 per unit. Now, here's what matters. The sale price exceeded the property's IFRS value. If you don't know what IFRS is the standard that they use to evaluate buildings for valuations. That means private capital is valuing the asset higher than public market benchmark. And that's a critical signal because at the same time, Minto is being taken private in a $2.3 billion transactions. And they're using roughly $67 million from this sale to pay down a variable rate debt that they have. So what are we really seeing? So this isn't distress. This is institutional repositioning. Public capital is stepping back and private capital is stepping in. And historically, these transactions create an opportunity window. Now let's layer in policy. So Ontario and the federal government announced an $8.8 billion housing and infrastructure plan. On the surface, it looks like a major supply catalyst. Development charges will be reduced by 50%, HST rebates up to $130,000 per unit, significant transit investment. And here's the critical perspective. This is a long-term framework, no immediate solution in place. The funding is spread over 10 years. Development charges reduction depend on municipal participation, and it only addresses part of the cost equation. Construction costs are still elevated, financing is still expensive, and timelines are still long. So while this improves feasibility, it doesn't guarantee execution, and that creates a gap. Now, let's zoom out to the broader economy. Canada's trade deficit widened to $5.7 billion. That suggests net trade will drag on GDP for the first quarter. But the underlying data tells a little bit more nuanced story. Imports surged 8.4% with volumes hitting record highs. And that's not economic weakness. That's businesses restocking after pulling back late last year. And at the same time, exports remain below 2024 levels due to tariffs and global uncertainty. So what we're seeing is a split economy. Domestic demand is stabilizing. External demand is still under pressure. And for real estate, that distinction matters because rental housing is driven primarily by domestic condition. Now let's add one more layer. Ontario introduced a $1.1 billion small business tax cut. The rate drops from 3.2% to 2.2%, which is effectively a 31% drop. But in real terms, most businesses will save about $5,000 annually. So what does this actually do? It helps, but it doesn't transform business economics. This is not a growth policy. This is a stabilization policy. And since small businesses employ over 2.5 million people in Ontario, the real impact is on employment stability, which directly ties to rental demand. Now, let's step back. Here's what we have. Institutional capital is repositioning, policies attempting to unlock supply, but slowly, economic data showing stabilization, but not acceleration, government support focused on preventing downside. The combination creates a transitional market, not a boom, not a collapse, a rebalancing phase. And this is where things get interesting because in transitional markets, timing mismatches create opportunities. Policy takes time to work, but financial pressure exists today. So where does distress show up? Check out this list. Developers waiting for feasibility, land prices or land purchase at peak pricing, projects outside key transit corridor, and owners facing refinancing pressures. And where is the opportunity? Acquiring assets from motivated sellers, buying land at reset valuations, target urban strong rental nodes, and positioning ahead of policy impact. The key insight here is the opportunity is not the policy itself, It's in the gap before it takes effect. So what should investors do? First, adjust your expectation. This is a stability-driven market, not a high-growth one. Second, be very selective. Not all assets will perform equally. And third, focus on timing, because the best opportunities often emerge before market stabilizes, not after. The biggest mistakes right now is trying to label the market as either strong or weak. It's neither. It's uneven. And in an uneven market, the advantages go to investors who can see multiple signals at once, understand timing, and act with discipline. So the real question is, are you waiting for clarity or positioning ahead of it? Addy Saeed is a licensed real estate broker with Remax Gold Realty Inc. and a member in good standing with Canadian Real Estate Association, the Ontario Real Estate Association, and the Toronto Real Estate Board. He's also licensed with the Real Estate Council of Ontario under license number 4735346. In addition, Addy Saeed is a licensed dealing rep with Westcliff Corporate Finance, division of Waverley Corporate Financial Services Limited, which is an exempt market dealer registered in Ontario. The content is not intended to solicit or provide specific investment advice and is provided for informational purposes only.